As college students entering adulthood, the term health insurance can seem super scary and complicated. Don't worry, we've been there. Let's equip you with the right knowledge to help you break down this beast together. Put simply, health insurance is a contract that requires your health insurer to pay some or all of your healthcare costs in exchange for a premium, aka the amount you pay for your health insurance every month. Within the umbrella of health insurance, there are different factors that impact the pricing, benefits, and assets of each plan. Let's look at a real-life scenario for context. This is Jessie.
Hello.
She's a UC Davis student studying computer science and is graduating in about a year. She's super active with campus activities and loves to indulge in outdoor sports. After a hard winter quarter, she decides to take a ski trip to Tahoe to relax and have fun. Unfortunately, the slopes that year were pretty icy, and she ended up tearing her ACL. Thankfully, she's enrolled in UC SHIP, which means her university-sponsored health insurance plan will cover most of the expenses. This gets Jessie thinking about what would have happened if she wasn't in school and didn't have UC SHIP. Jessie reaches out to a health enrollment counselor to learn more. The counselor talks to Jessie about her options after she leaves school. These are employer-based plans, where employers have negotiated set plans for their employees, marketplace plans, which provide shopping and enrollment services for medical insurance, or she can stay on her parents' plan until the age of 26 under the Affordable Care Act. When choosing a healthcare plan, there are generally 3 categories of plans to choose from: PPOs, HMOs, and high deductible plans. The counselor recommends Jessie evaluate her healthcare needs and finances to inform her decision. She explains that a PPO will give Jessie the freedom to pick healthcare providers from within her network, which will cost less, or outside her network, which would cost more. Although a bit pricier, PPOs offer more flexibility when it comes to finding providers. You would pay a percentage for most services until you reach your out-of-pocket maximum, the maximum amount you pay for covered services for that enrollment period. Jessie could also sign up for an HMO, a plan that limits coverage to a pre-made network of contracted doctors and health providers. This plan would be more affordable for Jessie, despite restricting her healthcare options to only those within the HMO's network. Alternatively, Jessie could also sign up for a high-deductible health plan. The monthly premium is usually lower for these types of plans, but you have to pay more healthcare costs yourself before the insurance company starts to kick in. This is called the deductible. Let's imagine Jessie tore her ACL after she leaves school and no longer has UC SHIP. What should she expect to pay? With no insurance, she'd basically be billed for the full amount. Assuming Jessie chose an employee-sponsored PPO plan after graduation and has already met her $1,500 deductible, her payment should then be pretty straightforward. Jessie should expect to continue paying her monthly premium. Then she might have a co-payment of $20 for the pre-op appointments. A co-payment is a fixed amount you pay for a healthcare service. Then, given that she's already paid her deductible, Jessie would pay a percentage of the total cost of surgery up to her out-of-pocket maximum for the year. This varies from plan to plan, but let's say for her it is $3,000. After that, she won't have additional costs until next year when the maximum resets. If Jessie chose an HMO instead, her cost would have been lower, but she might not get to choose her family favorite surgeon, the one who fixed her brother's ACL, twice. Thanks to health insurance, Jessie can focus her mind on the more important parts of life, building relationships, building her career, and recovering from her injury without having to worry about the crazy costs.